we've heard a lot this morning about managing expectations of founders and investors. And so I'm going to invite Max to come to the stage, the Managing Director of the Stifel Financial Corp, to give us some insight into valuations.
Thank you. Thanks. Great. Good morning. Anyway, thanks very much. A couple of comments coming out there. So I am Managing Director of Stifel healthcare practice. So it doesn't mean I run Stifel. That's a much bigger organization. It's a New York Stock Exchange listed investment bank. What I do is spend most of my time doing valuation work, valuing companies, most of them listed companies, but also do look at private companies looking to IPO as very common. So I spent an awful lot of time valuing companies. In my background, I've also been CFO of a number of biotech companies and have gone through the seed to sort of Series A, Series B round, through to looking at floating a company on NASDAQ from the CFO perspective. So open up to any questions you may have as we go through. I wanted to start talking about valuation with just looking at, just understanding valuation. Basically, when you're looking at a company, what are the key kind of attributes for those companies? And obviously, there's an intrinsic value of an asset or a company, which comes from the cash flows that will come in the future. And I think Christina mentioned it about how important the forecasts and the modeling is that comes from the company. And that's something we very much use, and I'll go into that in a bit more detail, but you're looking at the cash flows. But companies also have other values. We were talking, again, previous speaker was talking about their product and how that had intrinsic value in, or strategic value, I should say, for the Carl Zeisses of this world and the Alcons of this world. So your asset may have more value for other particular reasons. Synergies is often a reason. When you're, let's say, in M&A perspective, when you're looking at a company that's going to be bought out, often or not, there's a premium being paid. So why is that premium being paid? Well, often it is because there are synergies that are coming out of a combination, and part of those synergies are being shared with the existing shareholders. So those are sort of other aspects that you need to bear in mind when you're looking at companies. That's why, say, for example, when there's a rumor that a company is going to be bought out, shares price goes up because they know there's going to be a premium paid. The company buying that company isn't naive and going to overpay. They don't want to overpay because that will be destroying their shareholder value. So they're definitely looking at synergies that would come from that, creating that value, and how we share it between the target and the acquirer. Competitive reasons for acquisitions, and we know that there are competition authorities that prevent companies basically taking out their competitors, but still you can still make acquisitions where you're giving yourself a much stronger competitive profile. So you've seen the likes of now Meta, who have bought Instagram and have bought WhatsApp, and those clearly strengthen its position in social media. At the end of the day, and we heard from Christina again, when you're talking to, when you're trying to raise money, fundamentally it's about supply and demand. If you can get a lot more investors interested in your technology, then you can potentially get a greater value. And one of the classic examples, one of the companies I worked for previously was, we had investors who had given us a great term sheet in Europe, but we ended up getting an even better one from the US, and we had that competitive tension between the two, and we could get a better valuation for the company. There are other issues with that, and we'll go into that a little bit in the future as well. So supply and demand is really important. Casting your net as wide as possible, talking to a lot of investors, turning over a lot of stones is really important when you're doing a fundraise and trying to get that right valuation. Obviously, other aspects of, I just wanted to bring in, there are other aspects of valuation. Art obviously has value, even though it hasn't got any future cash flows or anything. So when you come to value those things, there are different aspects. And then collecting, stamps, for example, as things that, people like to add. And so they just wanted to bring different aspects on the valuation. So. See if we can move on. So why do you do the valuation in the first place? What is the reason for that? And, often it is you want to know what the company is worth. Let's say you're looking for an investment round. You want to know what the investors may think this company is worth. You want to give them a clue. They'll obviously decide and have an idea. Again, that brings in the supply and demand. If you have different investors have different ideas of what your asset may be worth. You may be an acquirer. You may be somebody looking to invest in a company and you want to know what it's worth. So you'll have to do a lot of valuation work in that. In VCs and angel investors, as you heard again from Christina, they're looking at what that exit value could be worth. So when you may be doing a trade sale in a few years' time from that asset, how much am I going to get? That's not so much looking at the pure value of that business in terms of what cash flows that can generate. It's looking at that stage of development, what are similar companies worth, and so what can we consider that? So that's comparative analysis, and I'll go into talking about that. But you may be wanting to invest in a business but not wanting to overpay, so you want to make sure that you know exactly what's a fair value for that, for the asset that you're investing in. The company, often management, have inflated ideas of the value of their business, and it's important that you have a realistic view of your value. I remember I was consulting for a business that invested in a whole portfolio of companies. They had around 20 companies, and I did a whole valuation of all those 20 companies. And it was a cold shower for the actual owner of the business and all those businesses, because he thought they were worth a lot more than that. It definitely brought him down a peg or two in terms of the value. In the end, I was wildly optimistic in terms of my valuations. They were still never quite achieving that. So there's really different reasons why you'd like to clearly not want to overpay or overestimate the value of your businesses. Another interesting aspect of valuation is understanding how to direct your investment. You may have more than one company one product in your portfolio, one asset, and therefore you may want to know which of those assets, when you do a valuation, you'll value each asset, and you'll start to understand better about which one is driving the value in your organization. So there's a whole raft of things, and we'll get onto that a little bit more later, about how you build value in your business through that valuation process. So then if we get to the nuts and bolts of what I do as an analyst, looking at valuing companies day in, day out, you have absolute measures of value, and this maybe comes a little bit at the first presenter talking about interest rates and the impact of interest rates. So if you're doing an absolute valuation, you're looking at what is either discounted cash flow, which is basically you're looking at, let's say you're a biotech company developing an asset, you think it's going to have, let's say for cataracts, you look at what the market opportunity is, how many procedures, like our previous presenter was talking about, and how much you could possibly charge for the product. And so you see what the market opportunity is, and then what percentage of that is you're going to achieve. You're never going to get 100% of the market. So you get that value, and then you look at what your margins would be, and so you get a cash flow in the future. But obviously you're going to have to spend money today to get there. So then you put in your expenditure that you think it'll take to get to the market as well, and that creates a flow of cash, what we call a discounted cash flow. Or you can look at a net present value, which is just a smaller version of a discounted cash flow, where you can use risk, and you can then use risk adjustment. So obviously it's not 100% chance that the product will get to market. Maybe it's a 10% if it's a phase 1 asset. The drug in phase 1 is generally seen as 10%. Phase 2, your risks are reduced, it's 20%. Phase 3 development, this is when you're doing your final stage of development, is about 50-50 chance of getting to market. So you would do those adjustments, but it gives you an absolute value. But that's really looking very long term, and so it's very dependent on those assumptions that you make. What's less further out there, but nearer term, and it depends on the business. So obviously a development stage company that's just investing at the moment has no products in the next sort of 3-5 years time. That's not appropriate to do a sort of comparator, but you can do PE so price and earnings. So this is if you're a company that's making money, you'll have earnings per share, and you divide that into a price, and then you compare it to other companies and say, okay, so what's reasonable? So maybe it's like in the UK market trades on around 11 times PE. So that's for every let's say for every pound share price, you probably pay, or 9p of you get 9p of earnings each year, that sort of thing. EV to sales, or that's economic value, which is basically your market value plus your debt, or less your cash. If you've got a large amount of cash, you take that off. So your economic value, and you divide it by sales. So if I've got a revenue generating business, even though I'm not making profit, you can still value the business. You can compare it to other companies that are similar to it, and then you look and say what sort of levels you should be trading at. So, for example, companies often trade at somewhere in the healthcare space, somewhere between 2 and 5 times sales. So you can say, okay, my business has got 10 million pounds of revenue this year. What is it worth? Maybe it's worth 20 million pounds. But if I've got really strong growth, really good profitability already, you could be up at more 5 or 10 times. The tech, in the tech boom, you had companies, trading on up to 20 times revenues in the tech space. So there is obviously in the property field, or let's say you want to buy a manufacturing facility, you might consider this is replacement cost. It has less to do with sort of the tech companies or health tech companies that we've been talking about, but it's an important perspective. But when you're then talking to investors, you've done this process, you've got your comparative valuation or your absolute NPV valuation. They're going to ask you, well, what was your last round? And you think, well, I don't really want to tell them what the last round is because it was not very high, or, I want to get a big step up here. So, tell them what the last round is. They're going to find out anyway. But what you want to know why, or be able to explain why you see a big uplift in that valuation. So, we've had a big milestone achieved in the last 3 months. So we think we are worth a lot more than we were, let's say 6 months ago. So these are the sort of aspects that you have to factor in when you're discussing with investors about the potential value of your business. So probably the hardest type of company to value are those sort of platform technologies. I don't know if any of you out there have a platform versus a product or a service. As I say, products and services, you can do, on a service, you can do a revenue multiple. On a product, you can look at the future cash flows coming from that product and then create a net present value of those. Platforms are more challenging because they generate a potential flow of products. And probably the classic example here was way back when you had these antibody companies that were all being developed. Phage Display was, and you had in the UK, you had Cambridge Antibody Technologies. In Germany, you had Morphosis. In the Netherlands, you had a company called Crucell. And they were all trying to generate products using antibodies. Large number of products now in the market are all generated by antibody and phage display technologies, and that was applied by these companies at the time. But you could compare the two of those three businesses and say, okay, well, they should have a platform value for that, and then you have added on to that the products, the value of the products in their pipelines as well. So you added that, and so it gives some value to technology platforms. So comparative analysis is really a very good means to do that. Moving on, how do we actually do the actual, valuation? And obviously, go to the history. If you're like Christina and you're looking at a company and you're evaluating the company, the first thing you'll say is, can you give me your last year's annual report, your financials? Maybe for 2 or 3 years, and see what the progression has been. Even if you're not a loss-making business that's doing research, they'll want to see that because they want to see how much you're spending, because that again is part of the valuation process. Then you need to forecast out and look at the future. If that's the product out there in the future, you do what we just discussed with the cataract example, where you look at the number of procedures, the cost you could get for that, and then the potential market share you'll get of that opportunity. So you look at all those factors to get where you see the potential value, and then possibly do some sensitivity analysis. Let's say we're not going to do all that. We're not going to achieve the 100% revenue that we're expecting. Maybe it's 80% of what we're expecting. What does that do to our valuation? So you get some sensitivity, and investors really like to see the sensitivity around that. So very important as well. It always helps to understand this whole process helps to understand what the drivers are to your business. If you've got more than one avenue in particular, it can tell you what is the most important factor, or which is the most important product to focus on and invest in. You may have 2 or 3 opportunities. If you've managed to raise, what often happens when you're raising money is you don't manage to raise enough. You go out to raise 5 million and you only raise 3 million. So then the investors are saying, well, you told us you were going to do X, Y, and Z, but I can no longer do X, Y, and Z because I haven't raised the 5 million. I've only raised 3 million. So I can only do X and Y. So which are those X and Ys? Why are you going to drop the investment in Z? And you need to know that X and Y are the 2 aspects of your business that are going to drive the most value. And doing evaluation is really important in order to understand which of those 3 assets I'm going to focus my resources on, because I don't have money to spend on that third one. It might be my pet project. I might love it, but it's not the one that's going to get further investment, and it's not the one that's going to drive value. It also helps you to understand the risk as well. So I talked about a phase 1 project might be a 10% chance of success. But let's say it's in an area where there's already a product on the market. My drug works exactly the same way, or maybe it's just a modification. Again, coming back to the cataract example, they were using existing drugs, so the risks there are much lower than if it was a new drug that they had put into the cataract device. And they were delivering a totally new innovative drug, much higher risk. So understanding your risk is also an important perspective. You do want to have a balance of that risk. You don't want to put, well, you may want to just go high risk and go for the big high reward program, which is the most sexy, but you may also want to go for the one, or balance that risk with one that's this one's going to get to market and we're pretty sure, and will generate a nice bit of return, and will then therefore also be able to invest in a much higher risk program that will really be the icing on the cake, as it were. Obviously, this whole investment process or valuation process becomes a basis for negotiation. At the end of the day, your valuation is only something you internally have done. You're talking to investors. Again, maybe they don't come up with what you'd like. It's again getting traction, getting multiple investors interested in order to get closer to your valuation round. I mean, we did an investment round back in 2018, where there was at that time there was a lot of interest in investing in biotech, and the market there was quite good liquidity, and we actually got multiple offers, and then you could get closer to your expected valuation. But in a tough market like this, you very well be getting something at a discount. You'll be investing your shares, selling your shares to new investors at a discount to where you see the fair value. So once you've done your valuation, then things change. You have your revenues. If you've got a revenue generating business in the next quarter, the valuation could change depending on where the revenues are going. You may have done a great partnership deal, looking at a markup in your valuation. So the valuation is always changing, achieving milestones. It's de-risked. Somebody else who's developing a similar product has managed to get theirs approved, and that therefore de-risks your program. So there are all sorts of aspects that will change that. Time is a really important aspect. Obviously, in discounted cash flows, you're looking at time. So the classic is you spend another year developing your program. You thought it was going to get to market in 2028 or 2027. It's now actually slipped a year. So you're actually on a valuation terms where you should expect to see an accretion of value given that time, you're nearer to market, you end up not being nearer to market. So how do you deliver value? You've got to keep to those timetables. You've got to try and deliver what you say you're going to deliver in the time frame in which you've said you're going to deliver. There's big changes in value. We saw yesterday Roche bought a company called KEYNOTE Therapeutics for 2.7 billion. It had 2 programs in phase 2 development, 1 in phase 1, but it was in this GLP area for treating obesity and diabetes. Massive area. Suddenly, if you're a company who's got a GLP-1 in phase 1, suddenly you've got, fantastic, KEYNOTE's out there. Suddenly you've got all these investors who are, getting more interested in your asset. Your asset value has just gone up because somebody else has done a deal. So it's important to look out and see what competition is doing, see what's going on in the market, understand how that can impact your valuation. So hopefully you've seen there's significant benefits coming from doing the process of valuation. If you don't value your own company, it's really hard to. Why should somebody else? Why should an incoming investor tell you what your business is worth? It's probably it benefits them to tell you it's worth nothing, doesn't it? They're going to invest. Well, it's not really worth very much. They're going to, if they're really interested in your technology, they're going to tell you all the pitfalls about your technology because they're worried about you actually getting maybe what you think the business is worth. They want to pay less. They want to get it for lower value. So understanding the drivers, that helps you build value in your business. So as I kind of explained, you can focus on the core assets that are going to deliver more value. Risk, it tells you understanding the risk of your programs. If you've got different programs with different risk profiles, or how do you mitigate the risk in that profile? Is there something an experiment you need to do that will de-risk this, which will make it more appealing to a potential future investor? Better understanding the market opportunity. Often doing the valuation makes you look at, okay, what is the commercial potential for this? What the company I worked for previously was in RSV. We needed to understand, how many children were getting infected with RSV and being hospitalized. What could you use as what price of a product at to go into the market? You had to understand what the competition from the vaccines that were being developed for RSV. Would a vaccine totally take the whole market? Well, no. If you know from flu, most of people do not actually get flu vaccines, even though they're available. Same is very likely to be from RSV as well. So we understood when we were discussing with VCs that, when they ask those questions, is your business really going to be obsolete by the time it gets to market because there are going to be vaccines out there? No, the answer is we've already seen from flu that you got flu vaccines, but the treatment for flus are also available and do sell significant numbers. Understanding your competition allows you to understand what market share you will get. And this all comes from a valuation perspective. So by doing the value, you understand a lot more about your business, leading you to better understanding of the competition, and then you totally understanding it, educating the acquirer or the investor about your business. So hopefully this has been a bit of a very brief intro into the valuation. I'm very happy to answer any questions that you have in terms of valuing companies. But other than that, I'd just like to say thank you for listening.
Hi, Max. That was great. I was just wondering how you cope with companies that pivot. They go for investment in one market sector and then decide to pivot to another market sector. How do you come up with a valuation on that?
So you do see that, and you obviously have to understand. I mean, this could be some company is developing something that then becomes clearly unattractive, and then they've decided to move market and are looking at another. And you just apply your valuation techniques that we've just gone through, and you apply it to that new opportunity. You'll be a little bit more cautious about it because obviously this wasn't the intended use of the technology or however, but it doesn't necessarily mean it's going to be unsuccessful. So you just have to evaluate it on the basis of what the opportunity is. Is that answering your question?
Was that a yes, Martino?
Yeah.
Yeah, thanks, Max. What factors do you look at? This is about DCF. What factors do you look at in coming up with a DCF percentage to apply? And what sort of range of numbers do you get, for example, for VCs investing in startups?
So good question. I mean, VCs obviously typically want a 20% plus return. So they will be looking at that type of discount rate. Public markets will be looking at closer to sort of 9 or 10% discount rate. Probably a hurdle of 15% would be very good for an investment decision. So I think those are the sorts of rates. But when you're valuing your business, we for biotech we tend to use around 13%. Maybe just historically has been that, but I risk adjust as well. And the VCs will probably not do so much that type of valuation technique. They will look at, say, okay, you're in GLP-1 space. We saw Roche buy a business that had 2 phase 2 assets and 1 phase 1 asset in the GLP space for 2.7 billion. Now, all right, they may not think that, but if I can invest for 100 million in a phase 1 GLP asset that in 2 years is going to be phase 2. It sounds attractive. So they're more looking at the exit, or what would the valuation be on the public markets on Nasdaq. Most of the VCs nowadays will be looking at a potential exit route, 2 exit routes. One is a trade sale. The second is obviously a Nasdaq float. I think European markets are pretty unattractive for therapeutic companies. Medtech companies, that's probably different, but still not as attractive as Nasdaq.
And then just following up on the risk adjustment of your NPV, you mentioned 10%. You talked about attrition rates at phase 1, phase 2, etc.
Yeah.
How do you? What percentage of companies fail for safety reasons, and what fail for efficacy reasons? Have you got kind of percentage numbers?
I mean, there are stats on that,
yeah.
which I have seen. There's not pure efficacy and safety, because there's also bad trial design as well. And I think safety is probably about 30%, but it will depend on the stage of development. So it's, poor trial design is another thing, or just failure to develop the product is also an issue. Emma?
Thanks, Max. Yes. What's your view for private companies on down rounds? Do you think companies should avoid them at all costs, or do you think sometimes they just have to bite the bullet?
So it's interesting, again, previous speaker was talking about possibly the mistake they made was not raising more money. And generally there's an old adage in biotech, you raise money when you can, not when you have to. In terms of a down round, you just have to face that. I mean, you don't really have a choice. If you need the money, you're going to have to raise it at that down round. So I think you just grin and bear it. Obviously that, there is slight bias there, because that tells you your existing investors are probably not the only investors, because existing investors don't like down rounds either. So they're likely to do it at the existing round. The last round, if they think there's been some destruction of value, they'll still do it, or the market's turned down. So the fact you're telling me it's a down round tells me the existing investors aren't supportive, and you've had to get a new investor in. So you take it, but hopefully next round you've got some good milestones and you're going to get an up round next time.
And in terms of like an orphan drug strategy, which is obviously very popular in the life science, at least in the United States, right, in the UK, but many of the orphan diseases may not have measurable outcomes, right? So in terms of poor trial design, and there's not measurable outcomes that are standards, within the regulator, do you take a risk-adjusted perspective as a result of that? Meaning, because there's not a measurable outcome.
Orphan or rare diseases is an interesting space. There are potentially, you raise an aspect for why the risks might be higher, but they're often genetically based, and therefore the risks are actually generally seen as lower. So So I guess my answer would be you probably got. Sorry, the answer would be you're actually. I think you'd be treating yourself a bit unfairly if you said, "Oh, because we've got harder, less defined endpoints, it's a higher risk program." It's probably lower risk because it's a genetic disease. So you need to balance those factors out. So I don't know what you'd have to look at each situation, but you're right that if there's no, yeah, the trial designs, yeah, and the endpoints. I mean, you come up with an endpoint by a negotiation with the FDA, so you should have an endpoint there. But if it's a single genetic disorder, then your risk is lower because you've got homogeneous population. Whereas if you're looking at cardiovascular, you've got different people with different issues, and you're looking at them all together. So generally, the risk in rare diseases is lower than the risk in other more heterogeneous patient populations.
Thank you.
Great. If that's everyone for questions, then just takes me this moment to thank you all for